Hello and welcome back to the lesson. And today we're going to talk about trading consolidations. Now we have actually covered trading consolidations on the first module and also on the third module. We talked about consolidations, and this is just a refresher of trading consolidations. So I'm not going to necessarily go back into the basics of consolidations and what they are and how to anticipate them because we've actually covered all of these on the previous lesson or multiple lessons previously. But I want to talk about day trading consolidations and how you can view consolidations from the perspective of smart money versus the traditional sense of how actually trades consolidations. Classically, retail traders will look for breakouts out of consolidations to establish a direction of buys. And smart money would actually utilize the breakout and they would actually initiate the breakout of the consolidation and then they will utilize the breakout to fade the consolidation because classic retail chart patterns indicates that when you see consolidations in price, the market is squeezing out of a big rally. That is classic consensus in the retail sphere. Now, oftentimes what smart money will do is smart money will engineer a false and sudden run outside of consolidation, and it's just going to be a very, very quick run. And that run sucks in retail to chase what they believe is a break out of consolidation. And retail draws all the measured moves and all the Fibonacci extension levels, and they're anticipating, strong uptrend. Let's say for a bearish order flow, for example, and you see a very sudden upside expansion out of the consolidation in a bearish order flow, and the market was just completely reversed and continue to go opposite to the initial breakout. And this is classic power three setup, right? That's we've talked about this before. That's what we call the accumulation, manipulation, distribution cycle in price, where the market accumulates inside a consolidation, and then the manipulation play is where the market sees a sudden expansion out of consolidation, and usually that sudden expansion is going to be counter to order flow or daily buys, and then the market completely just reverses, puts the brakes, and everyone reverses and starts to go its true direction. Retail traders will actually just the same as for a sell. Retail traders will buy the previous low and sell the previous high because they view old highs and lows as support and resistance. This is classic support and resistance ideas. Now, when I was in IML, this was years ago, right? So when I used to trade with IML some time ago, the way I learned about support and resistance, it was from a guy. I think it was actually the owner of the company. His name was not Steve Meyer. I'm trying to actually remember. Christopher Terry. Okay, so Christopher Terry was his name, and the way he taught support and resistance was, imagine you're in a building, right? So if you're in a house, and I'm gonna draw, it's a very wacky drawings right now. So you have an house like this, okay, and this is the house here, all right. And I said it was gonna be wacky. If you are standing here, that's the floor of the building. If you try to jump and get through the roof, you cannot get through the roof because the roof is the ceiling, right? And that is what classic support and resistance prices are. And the classic retail textbook teaches that the market remembers old prices. So whenever you see a bounce from an old area before, there's a very strong likelihood that the market is going to see a continuation bounce if it revisits that level at a later time. That's the general retail consensus in terms of classic support and resistance ideas. So classically, what retail would anticipate if the market's trading back down into an old low is they're looking for their classic chart patterns because they believe that the market is from trades on a psychological standpoint, and so they want to see repeated or repeatable patterns or cycles in price. So as the market starts to run lower for the old low there, they anticipate a classic price reversal because they believe that that is a potential support forming. So what they'll classically do is, as the market starts to drop down into the old low, they'll buy the run into the old low there, anticipating bounce. Okay, and oftentimes what the market will do is you would see a lot of times the market will trade down into the old low, and then the market actually blew right through, right? I don't know if you guys have actually traded patterns like this, but I used to do so 2017 going to 2018. And there were a lot of times where I'll draw trend lines and I would expect kind of like equal lows and the market touch the trend line and see an expansion higher. And the market would just blow right through. And I'll think I missed the opportunity. And I'll try to short the retest back into that low and the market just goes just straight higher. And this is classic retail anticipation in terms of price action, where as the market returns to an old high, they're classically expecting a sell off because they look at the high as resistance. And that's why we call old highs retail resistance and old lows retail support. Now, there are instances in which you can utilize old lows and highs for trade ideas, utilizing rejection blocks, right? But that always has to be in line with order flow, always. Okay, so just to get rid of this and go back into our slide, retail traders will usually chase expansions that originate from the equilibrium. So when the market is at the equilibrium range, and equilibrium is price action that is neither a premium nor discount. And when the market is at equilibrium, I've told you a lot of times that when price is at equilibrium, the market usually tends to consolidate. Retail would chase the expansions, and usually those expansions are going to be sudden expansions. Retail would chase those sudden expansions from equilibrium, anticipated a run into the extremities of the range. Right, they're looking for a run into external liquidity, either on the buy side or on the sell side. And what smart money will actually do, smart money will fade that expansion that originates from the equilibrium because it's all engineered to create a sentiment. And that was what we're talking about on the previous lesson, where we have sentimentally and the market will make sudden moves against its intended direction to then engineer sentiment. And usually when it looks the most scary to go and buy an asset, that's when you actually should be buying the asset. Or when it looks more scary to sell an asset, that's when you should be going in to try to sell a pair because everyone else is chasing that explosiveness or that displacement in price. Now here, this is trading consolidations, and we're going to talk about trading internal liquidity runs. So we have a classic range that defines our premium and discount, and then equilibrium. Equilibrium is generally the 50% of the range, and we have a range out here where external buys liquidity rests. Now we also have a range low here where external sells liquidity also rests. As the market makes a short-term high and then a short-term low in direction of order flow, the market will go up into the range and create a or meander around equilibrium. And generally, from what I've taught you by experience, when the market is trading around equilibrium, okay, what you're looking for is you're looking first off to be patient. Okay, you don't want to go in and rush and look for continuation patterns or continuation trades. Okay, we talked about utilize the quota theory for consolidations and how you can trade breakout systems with consolidations. So in price action like this, in consolidations inside the range, not outside the range, the market will make or squeeze into a tighter range inside of an overall larger range. And what would happen is the market will usually see a very sudden run higher. Now, what retail does here is retail will go and then buy the breakout, thinking that we've now seen a break out of the range and they're expecting the market to run for what they believe resistance is, where they have to take profits. And the market will run above and suddenly just fade against all their expectations and go and reach for the sell side liquidity from retail who was buying long up here. And they'll chase, Bowers is chasing the longs, smart money are selling into the longs from retail. And then they are using their sell stops to be counterparty liquidity to their orders. And eventually the market would ultimately run for the range look here or external liquidity because that is in line with higher time frame order flow. So in internal ranges, retail will view to buy the breakout out of a consolidation, and then the smart money would actually fade the breakout, which is what we're talking about on the first slide, right? Retail traders will look for breakouts to establish a direction of buys, while smart money will engineer and then fade breakout out of consolidation, and that is just classically what you can see here with this drawing, by the way. Now we're going to talk about trading consolidations, internal liquidity consolidations in a daily or 4-hour bullish order flow. Now the previous slide was for a daily or 4-hour bearish order flow. Now this is actually for bullish tested price. Again, you can see how all our narrative stems from defining where the drawn liquidity is and where price is coming from, which is essential to all the things we do. And that's why we have to start from the higher time frame and build upon that knowledge of price before going down into lower time frame price delivery. Now, with trading internal liquidity consolidations in daily or 4-hour bullish order flow, the logic essentially is just the same thing. The market trades up into consolidation, starts to consolidate a little bit, and then retail gets bored because you're doing all kinds of trade, looking for all kinds of pattern, drawing all kinds of triangular patterns and bull flags and flag bulls and everything, and the market makes a sudden break. And once the market makes that sudden break, retail tends to FOMO into the run, right? They'll see that quick expansion and they'll chase it. And a lot of times they'll sell the breakout after the move is done. That's when you're just shorting that breakout from the old low, thinking we're now going to see a run for external liquidity at this range low here. And smart money, again, they're engineering the sudden run lower to engineer a sentiment play for sells and then use that to build in a position for longs. And that sentiment for sells creates the necessary buys liquidity that institutions can then become part to up here and then ultimately up here, because our daily order flow and 4-hour order flow is also bullish. Okay, so as retail buys old low here, as the market runs lower, the phase of manipulation or the phase of sentiment creation originates in two ways. As market runs down to this old low here, retail will buy this old low thinking that is support. Remember the analogy I talked about that I learned when I started out trading, where the floor is the support, the roof or the ceiling is resistance. And whenever I see the market make old lows in price, there's a very strong likelihood that the market is going to retest them in the future when it retraces back into them. This is classic retail logic here, right? And that's the same concept here. As the market runs lower into the low here, retail is buying, and we call them weak long holders. So these are weak long holders entering into the marketplace, looking for longs with sell stops below this old low here. And then at the same time, as the market continues to screen below where retail anticipates this to be support, there is retail now engineering sentiment to go and sell short because of this aggressive run lower. So what we're doing here is we are generally neutralizing buyers or early buys in price, and we are at the same time inducing sells. So this quick run lower engineers buys liquidity, okay, at the same time neutralizes sells liquidity. And then the market runs high for old high where retail has buy stop, and then eventually the market is going to run for external liquidity up here. Now, with trading consolidations for external liquidity runs, this is for a daily or 4-hour bullish order flow. And classically, what happens is the market obviously creates a range in a 4-hour bullish order flow, and the market starts to retrace down into a level where smart money wants to be, or it wants to start sponsorship for longs or for the buy side. And as the market trades down there, preferably into an old low, retail looks at that old low as perfect support. So they're expecting future prices to hold there and also find support there. But the market forms a short-term bounce. Now, this bounce really is actually important, because what the bounce does is the bounce convinces retail that we're starting to see a reversal from that low of what they believe is an old low. And usually what retail does, they'll add more positions in. Right, they'll start to add more and more and more because they've seen a little bit of displacement from their intended or what they think is support. And then the market runs aggressive one more time and scares them out of the trade. Okay, forces them to exit the trade at a discount that they initially bought the trade, aka they're exited for a loss, or altogether just goes for your sell stops. And then the market starts to reverse for the buy stops inside the range. So this is a pairing of external liquidity to internal liquidity inside the range. When you're trading runs on external liquidities like this, with the runs on internal liquidity, you're aiming for short-term internal liquidity and then external liquidity for consolidations that has to do with internal liquidity. And this is also trading consolidations for external liquidity when the daily or 4-hour time frame is a bearish order flow. Again, we have our defined range of a high and a low, And as the market starts to trade back up into the high in a bearish order flow, smart money will sell above all the highs to retail shorts, aka as the market runs up into this eye here. Retail think that is no die, and the market should generally find resistance there. And then retail is shorting that, and then the algo draws, or if that draws the market even deeper into premium, which in the process neutralizes retail shorts, early retail shorts, engineers or induces retail longs, because now the shorts think they're wrong, and the longs are looking at all of this delivery and they're chasing this, and that engineers retail sell stops, and then the market runs lower for that. Now, with runs and stop, you can. I did a lesson on anticipating stop run. I'm actually gonna put it as a part of the course. Anticipating stop runs versus um, anticipating shift in structure. How can you anticipate stop runs using divergence with the interest rate market? So if this is a major currency, like a foreign currency pair like US CAD, USHF, pound dollar, euro dollar, you can compare the run above a range to that of the treasuries, US treasuries. If it is a cross pair, then you want to compare that cross pair or cross asset against a related cross pair or relative cross pair. Okay, so for example, if I'm trading pound CHF, what's going to be a related cross pair I can compare runs on liquidity against? That's going to be Euro CHF, because they're both correlated, where they have the same code pair CHF and then their regional currencies, or their similar regional currencies, which is euro and pound. Or if I'm trading Aussie yen, what's a correlated asset to Aussie yen? That's going to be New Zealand dollar yen, because New Zealand dollar and Aussie, they're both from the same region, so they're regional currencies, and then they have the same code pair, which is yen, right? So for crosses, all you're looking for is you're looking for a pair or an asset that has the base pair from the same region, and then the code pair is the same, right? So you cannot compare CAD JPY to Euro JPY. Okay, they're not from the same region. Euro and CAD is not from the same region, even though they both have yen as your code pair. Okay, if I need to compare CAD JPY, you want to look for a currency or an asset that is from the same region. If you wanted to look at, for example, Aussie yen, you cannot compare Aussie yen to Euro yen, even though they could generally trade in the same direction. But Aussie is not from the same region as Euro yen for you to go and look for divergence from, because you're not that closely related. So you're going to look for an asset that is actually closely related to the asset you're trading. And this is for the crosses, right? If you're trying to validate runs and stop using SMT divergence, which would usually is a tip off that your sudden run out of a range is a torso. If you're doing it for the majors or for dollar, then obviously you just need to use the US treasuries, and that gives you all you need in terms of information. So I would advise you to go watch the video. It's going to be the next video to this. Go watch the video on validating stop runs versus shift in structure, and that helps you define how to do so with the interest rate market using the major currencies and also on dollar. Now we're going to actually look at a live price action example of validating runs and consolidations. Okay, so we're going to look at internal liquidity and also external liquidity inside the same run for a daily sell side. All right, so just to quickly run through, you can see we have a very large consolidation. We have this here that starts the consolidation, and then we have this low here that is the discount low for the consolidation. And again, by the way, this is a daily time frame. Now we're going to define the range high here, and we're going to define the range low here. Now what you can see is the market runs above the high of the range. Now what I've described, or what I've taught you, is whenever you see the market run out of a range, you'll like to see the market not generally want to return back into the range. You want to see range expansion if it's going to reach for an external sell side liquidity, maybe something like this, for example. But if you see the market run out of a recent range, because there's a very strong tendency for the market to run out of a range and then return back into the range. This is what we call the L70 principle, or I think the Lagarde principle, right? So if it's going to return back in the range, usually it's going to run an internal liquidity inside the range. So this is a daily time frame. We've either run an external liquidity of this range, Now we have a internal liquidity inside this external liquidity. Now you can obviously see very clearly order flow is bearish in the fact that we are clearly disrespecting discount array on the daily time frame, and we are respecting premium. You see how the market trades up into this bearish order block, and we have displacement. It trades up into the bearish order block, and you can see how the market is running lower and disregarding this bullish order block totally. Okay, so we saw displacement lower initially, and then the previous day, which is Tuesday, we saw the market actually run above the highs from Monday, and we have the sell side liquidity down here. So our daily bias is bearish, and we're looking for this daily low down here, and that is where our daily low rests. So daily order flow is bearish. Now let's go and confirm with the 4 hour time frame what our order flow should look like, and you can see very clearly 4 hour time frame we're consistently making lower lows in price and lower highs in price. And you can see every single time we run above a short term high, like here where we run above a short term high, we show willingness to want to displace lower. Okay, so every time we run a short term high, which is classic price action, every time we run a short term high, there's a very strong willingness in price to want to displace lower. And so we're following through with the theme that we're looking for weakness on our pair, which is pound CHI. Now on the Tuesday, you can see before I go down on Tuesday, let's identify our premium on the daily time frame. Okay, so we have this bearish block which will trade up into 1, 2, and 3. Okay, and then we have a small volume balance in between these two candles. So the candle from 23rd on Friday to the candle from 26th of June on Monday. That's our volume balance. So we're gonna plot our volume balance, and we're gonna use a purple line for inefficiencies in price. And that is the premium high of our volume balance, and this is the discount low of our volume balance there. And we're gonna then take this down to a lower time frame. And on the 1 hour time frame, you can see again Monday, relatively clean nice here. The market declines lower and recovers going to Tuesday, and then on Tuesday the market sees a sudden run, which is your valuation by speculation. Where's the market actually trading up into? The market was trading up into a daily bearish order block. Remember when I taught you on the short-term trading module, whenever you see those sudden runs like that in price, the market is searching for an high time frame level, or a level that the central bank has a valuation on. So what is that level actually? That is this high time frame level. Right? You see, it's not just a random lower time frame level. It usually is going to be a key high time frame level, which is necessary for facilitation of trades. And you can see that sudden run higher. Okay, so the market was selling short from London going to New York, and then all of a sudden slams higher by 58 pips. No one is catching this if they were short. They're all out of the marketplace, and sentiment has shifted bullishly, so that also creates a pulling of sell side. Now we know daily order flow is actually bearish, so going into our lower time frame, which is today's price action, and you can see from here, this is the start of London session, the end of London session, and we're going to study this. Okay, we're going to study London session. So from the end of previous day's trading session going into London, you can see how the market stays in a very small and tight consolidation. Now we have a range defined, which is here as external buy side liquidity, here as external sell side liquidity, here as internal sell side liquidity, here as internal buy side liquidity. So we actually have a consolidation here. Okay, this is our consolidation. And if you remember what we talked about with consolidations for daily or 4 hour bearish order flow. So let's actually find this. Right? The market is gonna consolidate at the equilibrium of the trailing range, and if you pulled your Fibonacci from the high to the low, you can see we are at equilibrium, and you're seeing that consolidation at equilibrium of the range. Now, generally what the market will do is the market will make a sudden run out of the range, and then retail will go and buy the breakout. Okay, so retail will buy the breakout, the sudden run out of the range, and then at the same time retail will try to short the retest of that old high, thinking that is old high, so that should be resistance in price, and then the market will suck right through, convince them otherwise, and then put the brakes on them and run for just outside liquidity, internal and then eventually external, like I mentioned. And you can see here, that's what the market does. All right, the retail goes in here thinking that this run into this high, that, and you might be thinking, well, just nothing really special about this. I'm going to show you. Let me actually take this back. So I want to show you so you can see in real time how retail is interpreting price. All right, so as the market trades back up into the eye of this range, remember they're shorting that. They're thinking that is an old eye or an old area that the market saw delivery lower from. So you're going in there and they're shorting that, okay? And look at this on the 5-minute time frame, and it even is very clear. If they short here and they see this sudden run lower, what do you think you're doing? Are you going to leave your stop open, or are you going to jam your stop just above this high? You're obviously going to jam your stop above this high because you've seen significant displacement in the direction of your execution. So your thought is, or your thought process is, I've noticed you're excited about the fact that you've cut the move and you think the high of the day is in place. And then look at what the market does. Then the market runs higher and spikes the high. And what's retail doing? They're now stopped out. So the early shorts are neutralized, like we talked about here. And longs are induced, who are thinking that's a breakout. At this point here, you're not thinking about this as, oh, it is a torus of sell, because you're seeing the sudden recovery in price and you think this is a low in place, so this run higher is the real direction. But no. And then the market just absolutely runs lower again, and buyers in just here, and you know the market is going for internal liquidity first, and then eventually external liquidity in price. And the same logic also applies to yesterday's price action. In external liquidity runs in a daily or 4-hour bearish order flow, smart money will sell above old highs to weak retail shorts, as retail sells an old high thinking that's a top too early, and then at the same time retail also goes long as the market breaks above that old high, and that's what you see on GBCHF. Our valuation by speculation, we can tell the market leaves very clean lows down here. So by leaving these clean lows down here, retail thinks that is support. By leaving these clean lows down here, that retail is classic retail support. Now you're seeing displacement higher in price. Okay, so any retailer is going here thinking, okay, I want to short this. Look at this small little bounce from this range. Where do you think this small little retracement is? That's to give retail hope that we have a top in place and the market takes away their hope. At the same time, again, look at what I talked about with the speed of delivery. See how quickly the market runs up for that valuation by speculation, or that valuation point. That quick run higher to that valuation point, that sucks in retail longs. Plus all those guys who were trying to short inside the range, they're not but hurt or pissed off. Now they have to chase the move higher, and then the market puts the brakes on them, and see how quickly it displaces lower. What does this run mean? This is what I've talked about with Torus. Torus trades are one of the fastest delivering trades. Okay, they quickly put the brakes and quickly reverses, and it will oftentimes show institutional sponsorship, and that's one of the hallmark of Torus trades. Because Torus trades are one of the most premium, or not one of the most, they're actually the most premium and discount trades or executions you can get as an institutional trader. So hopefully this has been insightful. It's been an insightful lesson. I will talk to you on the next one, and trade safe.